Welcome back for another well-fed retirement insight. Today we're going to be talking about tax rate risk and actually looking at the impact that it could have on a federal household in retirement. So when we're talking about tax rate risk, what we have to understand, one of the core decisions we have to make when saving towards the future is what we call the retirement taxation gamble. We are forced to place a wager on whether we think taxes will be more favorable or less favorable when we need the money, when we need access to our savings. And so if you're in a position today where you believe your current marginal tax rate is significantly higher than the future marginal tax rate, it would make sense to plant those seeds in a tax-deferred bucket, the traditional TSP, so to speak. Whereas if you are in a position where you believe that your current marginal tax rates, you're not going to see your income go down and drop 2-3 tax brackets, and you're worried that future marginal tax rates might be higher, then it would be time to use the Roth TSP, a Roth IRA, or cash value life insurance to really put emphasis on tax diversity and funding the tax-free bucket. So this taxation gamble forces you to choose. Are you going to pay taxes on the seeds or pay taxes on the harvest? Let's start by asking the question, does tax deferral still make as much sense in 2022 as it once maybe did? To help us understand that, we're going to look at a median income household. So that's a household with 2 children. And in 1980, that Main Street American family was earning about $16,000, which translates to about $58K in 2020 dollars, adjusted for inflation. Now that family saw their marginal tax rate in 1980 be 43%. Now, at that time, our debt was low, and as you can tell, taxes were very high. So tax deferral certainly had its, benefits there. Now, today, we look at a very different situation. Our debt is north of $30 trillion, and our tax rates are 12% for the median income household. So that's a family making $68,000 this year. And that obviously much lower starting point than what we saw in 1980 when we had much lower debt. So then that family in 1980 was faced with the reality that in retirement they were expecting to take home significantly less pay. Their lifestyle in retirement was going to take a haircut, so they did see their retirement income tax brackets going down proportionately there. That said, today what we see is that many people in the 12% tax bracket are not dropping out of the 12% tax bracket. For federal employees, it's often the 22% tax bracket, and then you replace 80% or more of your income in retirement, and that keeps you in the 22% tax bracket. So when this is the question, it becomes, okay, well, what rates will that bracket see in the future? The other thing to keep in mind is capital gains rates were much, much higher than they are today back in 1980. And so there was much more impetus from all those different perspectives to utilizing tax deferral. Whereas today, again, we have much higher debt, we have much lower tax rates, and future rates are not known. So it makes more sense to try and clear that tax deferral for a lot of people concerned about future tax rate risk. Now, the thing about it is we were taught in a different era, right? So we were taught to replace 80% of our salary with a pension, Social Security, and a traditional TSP. But guys, here's the thing to keep in mind. Most of your pension is going to be taxable, 95% or more. And that is usually large enough to make it so that 85% of your Social Security needs to be reported each year on your 1040 as income, taxable as income. And that, coupled with a traditional TSP, is, creating a highly taxable income stream in retirement. So you might have a robust income, but you're going to be in the crosshairs of the IRS for a robustly taxable income. So what stands between us and the tax-free bucket? Well, as we just alluded to, it's the IRS. So to get money out of one and into the other, what we're looking at is clearing that tax liability through a process of Roth conversion. So utilizing Roth IRAs or utilizing cash value life insurance to take a taxable income stream and create tax diversity, or a more robust tax diverse income stream. Now, with that, the first thing we hear is, okay, well, wait a second. If I pay a bunch of money to the IRS in my 30s or my 40s, it doesn't get to compound in my 50s and 60s. Guys, here's what I would point out to you. Remember, that money is going to compound, like you said, but who are you compounding it for? Oftentimes we are a shepherd for the IRS's money. We are just, watching it grow in our account, but it's been earmarked for them. So what we have to highlight here is that is a common misunderstanding. There is a Roth opportunity cost myth that keeps many people from utilizing the power of a Roth conversion. So the question again, if I convert, I won't get to see any compound growth on that money I preemptively paid to the IRS. Well, guys, let's look a little closer at that. So we're gonna assume we have $100,000 to invest and that tax rates are 30%. Now first, we have no conversion, so we keep that $100,000 intact. But over here, you can see if we did the conversion, it means we have $70,000 to then grow after taking 30% out for taxes. Now, if that earned 200%, we see 100 grow to 300. We see 70 grow to 210. Now, for the after-tax balance on our pre-tax bucket, we take that 30% out of 300, leaves us 210. And our 210 in the Roth bucket comes out tax-free. You can see here, it is also 210. What that's telling us is that there is no opportunity cost myth here. If taxes are the same on the way in as they are on the way out, it does not cost you anything. If taxes go up, then you would have actually paid more in having waited. So here you can clear the tax liability with no downside there if we're wrong and taxes do not change. Now, let's look at that a little bit closer here because again, federal employees are unique in the level of taxable retirement income they expect. And that means we have to ask the critical question. Do you think the government will need more or less tax revenue over the coming years? Well, let's start by looking at where we're spending this money. So the largest budget items today, we have Medicare, Medicaid, $1.28 trillion. We have Social Security, which is $1.1 trillion. We have defense spending, which is $722 billion. And the fourth largest budget item today is interest on our existing national debt, $300 billion plus. Now guys, the combination of these four budget items represents 69% of all US tax revenue garnered in a year. Then the question then becomes, will these expenses go up or down in the coming decades? Well, as our population ages and interest rates increase, we know that is moving north. So here you can see debt to GDP is a ratio that we use as an indicator of future tax rates. So in blue, you can see the debt to GDP ratio as a percentage. In green, you can see our debt building up as a dollar amount, where in April of this year, we were at 30 trillion crossed over. Now what I'm going to show you is if we introduce the top marginal tax rate. And what you can see is that when our debt to GDP got out of control near the end of World War II, for the next 20 years, the majority of that 20-year period, the top tax bracket was above 90%. And for the entirety of the next 40 years, the next 4 decades, top tax bracket was above 70%. Today, the top tax bracket is at 37%, and our ratio of debt to GDP is worse than it has ever been. So the question becomes, if we see the correlation between debt to GDP and then the trailing effect of that in our marginal tax rates, how long do you think we can spend on this trajectory while taxing on this one? Well, the answer is not that long, because eventually that combination of spending and tax revenue would lead to the need for the IRS to take a much bigger bite out of your retirement savings. So what would that look like for a federal retiree? What would increasing tax rates look like? Well, let's start with an example here using Jim and Jane, and they're going to need $10,000 a month from a roughly $3 million portfolio that we're assuming earns 4%. And we're going to first, in this initial scenario, look at income tax rates and deductions from 2022. So we look at the cash flow, their desired income adjusted for inflation, and then we look at the TSP and their nest egg spending down over time. And you can see we have a $1.2 million cushion once Jane is hitting age 95. So that's their legacy in this scenario. And it's possible because the top tax bracket that they experience is 22% with a standard deduction that lets almost $26,000 of income go tax-free, so to speak. Now let's look at this slightly differently. What happens if we use tax rates from 2017 with a deduction from 2022? Well, 2017 tax rates were slightly higher. And what you'll see here is that we had a top tax bracket for Jim and Jane of 28%. And what that meant is that their $3 million cushion, which previously had left a $1.2 million legacy, has now the horsepower to leave a $200,000 legacy. So we lost $1 million there to the IRS over the 30 plus years of their retirement, while only seeing tax brackets that hit 28% as the worst case scenario. Now in this next iteration, we're going to show 2017 rates and the much smaller 2017 standard deduction. That's going to make more of the income taxable. And when we compare this, you see that staying in that top tax bracket of 28%, which is still much lower than what we experienced back in 1980, you can see that we were able to go through the entirety of that $1.2 million legacy and have a shortfall being introduced in the tail end here now, where the asset base has run out, checks would start to bounce, lifestyle would need to be adjusted. That's again at rates that are still much more favorable than what we saw as recently as 1980. So this final example, want to highlight, in 2017, there were still fiscal trajectory concerns. We didn't have enough tax revenue to say there's no worries about Medicare, Medicaid, or Social Security. So what now if those 2017 rates had to increase to actually try and address our $30 trillion of debt and the future spending obligations that we have? In this example, we're assuming 2017 rates go up by about half. So the 10% bracket becomes the 15% bracket. And if we see that play out, what you'll notice here is that the shortfall moves forward dramatically, right? So now Jim and Jane are both experiencing multiple years where they are struggling to make ends meet and the nest egg has been completely depleted. And that's only by hitting a 42% tax bracket. Now guys, $3 million, this healthy retirement income, you might think that they're in a phenomenal position, but it was wiped out by a 42% tax bracket when median income households were paying in the 43% top marginal tax rate, again, as recently as 1980. So it's important that you understand we can help you address this, but it's going to take some proactive planning. So how do we go about that? How do we mitigate this risk? Well, one of the ways is through Roth conversion. And so real quick, what I'm going to show you is simply if we had $100,000 earning 7% and we do a conversion where the assumed tax rates before and after stay the same. So if tax rates didn't change, what happens and how does that compare to tax rates that do change? So first, you see tax rates staying the same. You can see money building up. The traditional IRA has a higher balance because we are growing the IRS's share of that. The Roth IRA has a lower balance because you own every penny in there. But if tax rates are the same, they create the same distributions, the same results in retirement. But now, what if tax rates go up? So here you can see the traditional account building up the higher balance, but because tax rates are much higher, we deferred at 22%, but now we're being assessed 43%. And you can see that the higher account balance is running out much faster here. And the results of that are a difference of about $80,000 after tax when we're looking at that first year. And if we spread those results out, the difference over time is much larger. So guys, it is important to understand that if you're concerned about tax rates in the future and the way that they might trend and its impact on your retirement, tax planning and being proactive about that is critical. We have some other videos to help you understand some of the logistics and mechanics of doing that cost effectively. Thank you for joining us. We're here to help if you have any further questions.